Hi, everyone. This is Muhammad Akram. I'm the founder of Akram Assurance Advisory and Tax Firm. We are here to discuss pros and cons of Series LLC structure. I have a great panel with me. I will ask them to make an intro, but before we jump for the intro, I think it's necessary to give some housekeeping items. So all the participants who will answer 3 out of 4 polling questions will get the CPEs, and we will send you the CPEs within the next few days once the webinar is over. So let's start the conversation. Steve, can you please introduce our firm and yourself?
Sure. So my name is Steve Rosen. I'm a senior manager here with Akram Assurance Advisory and Tax. I've been doing audit and various other things in the hedge fund, private equity fund, investment management world for the last 20 plus years. And we here tend to handle audit and tax work primarily of, investment management companies and hedge funds, private equity funds, and alike.
Awesome. Thank you. Simon, please.
Hey everyone, my name is Simon Rivelis. I'm a partner at Rivelis Wahab. We're a boutique fund formation and investment management focused law firm. I've been practicing, corporate and securities law for about 23 years now, and I've been focusing on private funds in my own practice since 2011. We structure a variety of different funds, open-end, closed-end, for managers across the country and around the world. Yeah, it's a bit about me.
Thank you, Simon. Greg, please.
Yeah. Hey, everyone. My name is Greg Pops. I'm the managing partner of FundViews Capital. We are located in Miami, Florida, sunny Miami. We are a fund management platform. In my past, was also working for a different fund management platform, which at FundViews, we specialize in basically taking over the structuring and operations of private investment funds for both wealth managers and asset managers. So think of us kind of as a emerging manager platform that allows you to launch your fund on a series structure. So we'll talk about series LLCs today, but also outsourcing the day-to-day operations activities, working with the auditors, tax preparation, the lawyers, as well as the day-to-day administration.
Thank you. So Simon, obviously this structure has been in place for a while, the Series LLC, but not a lot of fund managers are aware of that. So my question to you is, can you please shed some light on the history of this structure and how you are seeing that the fund managers are considering this structure for their investments?
Yeah, no, absolutely. So Delaware was the first state to pass legislation in 1996 creating a Series LLC type of entity. So it's a distinct entity in Delaware, and about 16 other states have adopted variations of a Series LLC since 1996. And essentially it's a form of an LLC, which is a limited liability company, but statutorily, both in Delaware and in other states, this Series LLC allows a manager or any type of owner of an LLC to incorporate this type of entity and create segregated cells or series under the entity, which are remote from a liability standpoint from each other. So so essentially the debts and obligations of one series are, at least in theory, segregated from the debts and obligations of each other series of a Series LLC. And Greg can talk about some of the operational best practices in terms of how best to ensure that indeed in a worst case scenario, in a litigation scenario, that if the segregation of those assets were ever challenged in court, that the best practices in terms of maintaining the the segregated nature of those series is followed in terms of getting separate tax IDs, getting preparing K1s for each series. And Greg can talk about that when he talks about it. But essentially, for all practical purposes, you can launch separate segregated funds under one entity, and it provides certain operational and formation efficiencies. For each series, you're not filing each series with the state, although there is a new registered type of series in Delaware and some other states where you can separately register each series, which in certain circumstances has its own benefits. But a standard LLC is just a standard series LLC is filed once, incorporated once, and there's no additional state level incorporations for each series. So from there, maybe Greg can follow up with some thoughts.
Yes.
Or
Thank you, Simon. Craig,
Yeah.
would you like to shed some light what Simon was saying?
Sure. Yeah. So operationally, there's a lot of efficiencies running a series LLC depending on the circumstances of the underlying manager that's using it. But typically, it's best used, or it's most commonly used, I should say, by managers that want to launch several different entities that they're going out to raise for, that are either similar in the sense that they're one manager running all of these different strategies, or in some cases it's the same strategy, but they're running multiple different funds. From that standpoint, we'll talk a little bit later about the operational efficiencies and legal efficiencies, but it is front and center, first and foremost, important that you segregate each of the series as much as possible, because there is a theoretical issue where there could be cross liabilities, being that if you run one series, as an example, where there's a creditor on that series that goes after the assets of that series, but it can't be made whole from the assets of that single series, which is a series LLC, they could theoretically move on to the next series and charge liquidation fees or other things to the other series. My and likely Simon's thoughts on that are, if you play within the rules, you shouldn't be worried about that. But the rules are not explicitly spelled out, and it's more of a guideline. And we at FundViews put out a blog post last year on what we think the best practices of a series LLC are, which some pieces might be quite obvious, but some of them maybe less so. For instance, having separate bank accounts for every series is important. Having a separate tax ID for every series, separate Form D filings and Blue Sky filings, operating agreements for each series. And one of the most obvious ones is no crossing of assets, right? So, one series cannot make up, an invoice payment for another series, for instance. And making sure that there's separate investment registration. So if the series LLC has, generally one name, and then each sub fund or sub series has another name, and you're investing from that series into some investment, you have to make sure that that is registered in the name of the sub series and not the series LLC as a whole. If you're registering as a series LLC as a whole, then it becomes general assets of the series LLC, and it's open to litigation or other issues down the road if something ever happens to one of your series LLCs.
Awesome, got it.
Can I ask one question off that, guys, if you don't mind?
Sure, please.
So my question then becomes, you have a series LLC and you have ABC fund manager is the manager of Series LLC. Should each series have a separate manager, or should they all be the same manager of the series, right? To segregate because if I understood correctly, if the manager is the same across 5 different series and one goes out, you could technically go after that manager and then spill into the other series, correct?
No, it's a good question, Steve. I think certainly the manager is always exposed by virtue of having control over the whole series LLC. Absolutely. But I think, as Greg said, if all of the best practices, or at least most of the best practices with regard to maintaining the segregation of all the series, each series is followed, and there have been some cases over the years that have, in Delaware and other states, that have upheld the segregation of the series LLC, that you know, the assets of one series should be liable from, should be segregated, I should say, from the others. I think certainly if there's wrongdoing or negligence or recklessness on the part of the manager,
Right.
they could have separate liability.
Okay.
But
Yeah, I think to that
Thank
point, Steve, the assets of one series, you know, under the same manager of another series, the only assets that are kind of available in the case of wrongdoing are the assets of the manager themselves,
Mhm.
right? You can't dig into the fund and make, you know, the fund investors, you know, to make whole for something that the manager did.
Okay, that's a very good question, Steve. Thank you. So I think it's time for our first polling question. So let's start the first polling question. Give them a time. Okay, we are back. So our first polling question was, the process of forming a series LLC is different for each state, and Delaware is the most desired jurisdiction for series LLC. So the answer was yes. 100% people said yes, so that's awesome. So let's go to the next screen. Here, I would like to discuss, which we had already discussed that. I believe that, as you were saying, separate bank accounts, separate tax IDs, operating agreements, separate books. But my question to Simon is that, Simon, do you think the series LLC structure works for every fund manager, or only fund manager this structure is more specific for them? Can you please shed some light?
absolutely. No, I would certainly not recommend a series LLC frankly, for most managers, for them to run themselves. I don't want to plug Greg's business and fund views, but I think there are some compelling benefits to plugging into someone else's series LLC structure and you know, getting the benefits of the fact that it's an existing structure with existing relationships, service provider relationships, including bank, audit, accounting, legal, and you know, it typically plugging into someone else's series LLC, you're getting up and running faster. You have ongoing back office support. But in terms of setting for a manager to form a series LLC that they would be the manager of, there's only a relatively limited number of occasions that I usually recommend a manager set up his own series LLC. Typically, it's if a manager is looking to launch, you know, a number of new funds or special purpose investment vehicles every year, and the more funds or SPVs a manager is looking to launch, incrementally, the more benefits, arguably, there are of series LLCs, both in the amount of time a new series can be launched, and in certain cost benefits as well.
Awesome, thank you. There are some questions that are being asked here. I'm not sure if we should take here, but I think it's a right time. One of the questions someone asked, what is the benefits of series LLC versus having multiple LLCs? I think this is what you just answered, I believe, right?
The benefits of a series LLC versus multiple LLCs. Yes, the more LLCs a manager needs or is likely to want to launch, I think the more compelling the benefits of a series LLC become. If this is not, we don't frequently see managers that are launching dozens of LLCs a year, but certainly in the case of a manager that is likely to launch that volume or number of LLCs, then a series LLC could have some compelling benefits. It's hard to say where that line should be drawn, whether it's 2 or 3 LLCs a year, or certainly when you get into a manager that is likely to launch more than 2 or 3 LLCs a year, then a series LLC could make a lot of sense.
Okay, awesome. Thank you for responding to the question of one of the participants. So obviously, we are going to discuss all the pros of LLC structure. Steve, would you tell us a little bit more about what kind of savings they can have if they have a series LLC versus separate LLC in terms of overall cost?
Well, I can specifically speak to that on the audit, specifically on the audit side, right? It'd be almost equivalent to doing the audit of a master feeder structure, where you would do the bulk of the work up at the master fund and rely on that information. And a lot of that would carry down to each of these series, and then you would only have to walk into each series to verify whatever assets and P&L is going on in that series, because you're taking all the controls as under one fund manager, not each on its own. So you can actually wind up with a pretty good discount if you have, I don't know, let's say you have 6 series under one fund manager versus 6 separate entities, right? Auditor would charge you 6 different audit fees, where here you're not, you can have a pretty substantial savings because the manager is running all these series and everything works across the line. The same thing could also apply when you're doing the tax work, right? Because you're going to do one huge tax return, and each investor is going to say, all right, ABC series, DEF series, GHI series, right? So you do get some cost, almost like a bulk discount, let's call it, to make it easy for people. Right. As opposed to just individually, having to have 7 different audit and tax engagements.
Right. Awesome. Thank you, Steve. So, Mr. Time for another polling question. So let's go for the next one. Okay, so I think most of our participants answered yes, which is right. Easy question to get free CPs. This is more for Greg, right? I know you touch on this area regarding that flexibility. So I think I want you to see if you want to shed some more light. And second question I have with you is that how because some of our clients had a structure which was the special purpose vehicles, SPVs, and one of their manager was filed bankruptcy and they were out of the business. Now they were looking around. So tell us that how's your fund's view is different than what happened in the past, and how this flexibility works overall. Thank you.
Yeah, thanks, Mohammed. So I'll touch first on a little bit more of the flexibility and the pros and cons and kind of the savings. I think that's what a lot of people are looking for. You know, piggybacking off of what Simon said earlier, it really only makes sense for those managers that are launching multiple funds or SPVs a year. And, you know, there's savings on the legal side, obviously, where, for instance, you create a master PPM, you create a set of subscription documents that generally is standard across all of the series, but then you customize each series with their own supplemental PPM. And that way, the entity is already formed, the base document is already formed, and there's less documentation from a legal standpoint that needs to be fine-tuned for each of the series, which usually means it's slightly cheaper to set up each of the series. Again, that only makes sense if you're launching multiple series, you know, 3, 4, 5, 6, 10 a year. You know, on top of that, you're only paying one Delaware filing tax fee a year, right? The $300 Delaware fee. You're paying one fee for the whole series LLC. So of course, some managers that launch many different smaller SPVs might have 100 series on the series LLC. And then you really see savings from the regulation standpoint. On top of that, there's operational efficiencies and flexibility, which, for instance, opening bank accounts. If you open a bank account for a brand new fund, you're going to be asked a lot of questions. You're going to have a lot of AML, KYC, and due diligence. But if you have a series LLC and you're opening a bank account with your existing relationship for each of the separate series, then it can be a much easier process to handle that. Now, the caveat to that is really working with a bank that can understand and really truly handle series LLCs, because not all of them can. So the other flexibilities are, if you have an investor investing in one of your series under your series LLC, and you have a common investor that's on different series, they can subscribe as a already pre-approved from an AML KYC standpoint subscriber into separate series without having to go through the whole subscription document again. You can have your attorney or your legal advisor create a subscription to new series form, which is similar to an additional subscription form, where the investor will basically attest that they've read the supplemental PPM of the separate series. And that way, for your investors that want to invest multiple different series that you're running, it's a much easier process. And for your administrator. Those are just a few of the examples. From the standpoint of Mohammed, of this other service provider, they largely went out of business, I think, because they were mismanaged and because they were not charging enough to manage these SPVs. I think they were charging 7 years in advance. They were basing that, you know, those fees that they were charging on their ability to grow consistently, and when they hit a rough year, it killed them, literally. So that's one thing to be aware of, is how your service providers, how your managers of these series are charging. Us at FundViews, for instance, we charge mostly quarterly in arrears for our fees, sometimes in advance, depending on whether the manager is charging themselves in advance or arrears. We like to align that up with what the manager is charging themselves. From that standpoint, we're not charging 7 years in advance a non-refundable fee and going to leave you in the dust at the end of the year. But it does mean that we have to charge more money because we have ongoing operations to pay for. Some of these other providers in a similar light to the one that went under last year are venture-backed. They're basing their entire business model on their ability to scale to the point where they can automate pretty much everything across the board. The pricing reflects that, and I think that's over time going to become a problem because, in theory, automation is great, and we use it ourselves behind the scenes, but people drive this business, and they can continue to drive this business. Where everything needs to be fine-tuned and customized, and our job at FundViews is really, we're the white glove service provider. We want to, roll up our sleeves and really get a better understanding of our client's business and how we can help grow that business, because our fees are reflective of growth in that business. That's really how we've differentiated ourselves from kind of the rest of the pack.
Okay, awesome. No, thank you. That was a great, I think, comparing difference what you are doing versus what other service providers were doing who lost their business. I have one question someone mentioned over there. I think probably Simon is the right person to ask. Simon, is this LLC, series LLC structure is available only in the state of Delaware, or other states also offers that, and which other states you would recommend if someone doesn't want to go to Delaware?
No, it's a good question, Mohammed. I believe there's been a total of 16 states that have adopted. My sense is, and I haven't looked into this specifically, but versions of the Series LLC statute that's very similar to Delaware. Delaware is still by far the leading jurisdiction to establish funds and private companies, and certainly the vast majority of publicly traded companies are incorporated in Delaware. So I think Delaware is still in the vanguard of corporate jurisprudence and legislation. I would be cautious in, frankly, choosing any jurisdiction other than Delaware, because the most jurisprudence regarding LLCs and other corporate entities has been developed in Delaware. And I think certainly most investors would anticipate that the entity that they're investing in would be in Delaware. I haven't seen any compelling reason or justification to use a jurisdiction other than Delaware for a Series LLC, although I know that some jurisdictions have adopted the legislation. If it emerges that another jurisdiction has made a substantive or valuable modification to the Series LLC structure, we'd certainly be open to looking at it. As I mentioned briefly, Delaware has recently, I believe it's in the last 2 years, amended their Series LLC statute to allow for registration of a series, which is just an additional safeguard, frankly, to ensure that that there's a filing for each series, and especially in the context of secured transactions and collateral, we find that it's useful to register the series. Delaware certainly has stayed at the forefront of trying to address issues that have popped up with Series LLCs.
So it means it's very difficult for other states to compete with the state of Delaware when it comes to registration business, right? I think they are the leader, and they will remain the leader. I hope some other states will give them a tough time, or at least will offer more benefits for registration, but it seems like they are the leading state. Okay, let's jump to the next polling questions, the third one. So in order to get the CPs, you need to answer 3 out of 4. Okay, so that was the, I think we already touched on that, but I believe that there will be a lot of other fees will get involved with that, right? The franchise fees and the filings fees, right? For each entity, you will pay separate. And Greg or Simon, that each LLC will have to pay their own franchise tax at the filing.
Yeah, so there's a couple things I think are relevant here, Mohammed. We do think it's best practice to file for separate tax IDs for each series, but some groups, depending on their willingness to play in that gray area, can actually file one tax ID for the entire series LLC, and therefore one tax return for the entire series LLC as a whole. Again, we don't think this is really best practice, but it can happen, and that can lead to further tax savings, especially if you're setting up multiple series that have the identical investors and that. That can be a big saving potential. I think one more interesting piece to this is that with the registered series that Simon mentioned and alluded to, the security filings. So if you think about a traditional fund in the real estate lending space, for instance, if they're lending money backed by a property as collateral, they would want to typically, independently of a series LLC, want to file a UCC filing on that collateral. If you were to do that 3 years ago with a series LLC, you'd be forced to file that collateral under the series LLC as a whole. Whereas now with the registered series LLC, you can actually pay $75 a year per sub-series to register them in Delaware, and that way you actually have an entity registered as your sub-entity and can file that UCC filing in the name of the sub-entity and not the series as a whole.
Gotcha. Thank you. So I think it's time for another polling question. So fourth one. Okay, so series LLC offers tax savings than traditional LLC. Most of the applicants said yes, but some says no. I'm not sure how it would be no, but let's jump to the next topic. And so far we have discussed pros of the series LLC structure, or the cons.
Mohammed, but before you jump into that, can I just ask either Simon or Greg or both of them one quick question, which I think might sort of be relevant? So in a normal fund setup, assuming it's just a normal standalone fund, right? You're either a 3C1 or a 3C7, right? So now that you have these series, do you have that same limitation on investors that you would have as a 3C1 or a 3C7, right? So what I'm saying is each series going to be limited, or because it's a series, it's unlimited and that goes away?
It's a good question, Steve.
Yeah, it is a good question. For better or for worse, each series has to, comply with the securities laws and the Investment Company Act. But you can, one series could be a 3C1, whereas the second series is a 3C7.
Right.
So you can have differing elections across series. You could theoretically, market one series to the public under 506C of Reg D and not market the other. So, there's a lot of flexibility in structuring each series and also, tailoring each series to the, to the securities regulations that best work for that particular series.
Thank you.
I'm having some questions here. I'm having a little bit of hard time to figure out how to read those questions or need to make, yes, no, I can read. So someone asked here, can series company A have a different beneficial owners than series company B?
Yeah, so in terms of the series, so if I'm thinking about that correctly, if you have one series LLC as a whole and you have a series with shareholders in one strategy, they can have completely separate and different investors in another series with the same or a different strategy. It really doesn't matter. If you're asking, another way to think of that question, if you're asking whether or not the general partner or owner, the fund manager of the series LLC as a whole can be different in each of the series, that's not the case. There has to be a fund manager on the whole structure because there has to be an owner of that structure. The way that we handle that at FundViews is FundViews Capital LLC is the operator. We deem ourselves as the fund operator and manager of the entire structure. And we entitle each of these sub-funds, each of the series, to have its own investment manager. The way that we've written the documents at FundViews allows for these investment managers to manage the investments, sourcing and due diligence, as well as decision making and advise the investors on that series. Whereas FundViews Capital LLC as a whole, as the operator, is responsible for handling the operations of the fund structure. So it's a way where we've I think with Simon's help quite cleverly separated the role of the general partner into two distinct roles.
Here, we were also trying to, when we prepared the tax returns or we need some approval or signatures, what should be give us those approvals and signatures? Is this Fairview, the manager on that, or the underlying investor who has opened those series with you?
So it should be FundViews Capital as the manager, likely signing off on those, Mohammed.
Right.
But FundViews works with many different investment managers on each of the sub-funds, each of the series. So we find internally, there's nothing legally that says this, but internally we find pushing the final approval, doing all the work and handling all of the preparation work with the audit and tax firm as well as our administrators is what we're hired to do. But then we push that final approval to the investment manager.
Got it. There's another question here similar to that. I'm not sure, but can series company A be an owner of series company B?
Technically, yes. You can have investors in one series invest in another series. However, I think if that's kind of the route that you would want to go, it would be beneficial to have a master feeder series structure, which is when it gets really, really fun on Simon's side, where you would set up a series entity at the feeder level and a series entity at the master level, and you may have one or multiple series at the feeder level investing into one or multiple series at the master level, which then make the investment.
Similar to the master feeder fund, right? You can have also master feeder Series
You
LLC.
can. Yeah, you can.
You guys are genius. Seriously, I didn't know that. Thank you for teaching me.
Yeah, and then similarly, we're talking about series structures in this webinar, but there exists also segregated portfolio company structures in British Virgin Islands and Cayman Islands and several other jurisdictions that operate very similarly to a series structure.
Awesome. So let's discuss with cons of this, right? So who think, right? Probably, Simon, would you say something? This is really a con for series structure, the foreign states. Or not?
Incorporating a series LLC outside of Delaware in another state, Mohammed, or no?
Yes, I think it's more is like that. Was there any issues involved with that? I think yes, you are right. It is regarding the legislation and all that.
Yeah. No, just generally, I think certainly there are some, at least in theory, drawbacks to using a series LLC. Maybe first and foremost is, most people are familiar, generally at least, with, just a standalone company, an LLC. Once you bring in the nuances of a series structure, it raises a variety of different questions, which we're talking about obviously today. And so I think, one of the fears that many managers have using a series LLC is they'll spend a lot of their time, precious time, explaining to their prospective investors, what are the risks, if any, of a series LLC? How does it work? What are the benefits? And obviously, that's precious time that they may not want to spend discussing that. So I think first and foremost, that might be just getting people comfortable with it. Then, in theory, the corporate veil could be pierced between series. In a worst case scenario, that being said, series LLCs have, been increasingly used over the years, and they have withstood, when run properly, they have withstood, claims of piercing the corporate veil in court cases. So, we're comfortable that they're a robust structure that can work. But again, there's theoretical risks that make it maybe not ideal for some managers. Those would be the two main cons that would pop out initially in my mind. Greg may have some other thoughts.
Yeah, I think just to elaborate a little bit on that, one of the big drivers is obviously how many funds and SPVs are you launching per year, can drive on the pro side, but on the con side, what investors or types of investors you are raising money from really matters, and how big your fund is expecting to grow really matters. So if you're looking at launching a $10 or $20 million fund, these efficiencies really matter, because as a fixed fee basis, it saves you quite a bit of money. And so that's FundView's typical client is from 5 to 50 million. That's where we play, where we want to really drive value and help these smaller emerging managers launch and manage their funds and operations effectively on our series structure, or they can always set up their own series, and we run an outsourced COO service for those. When it becomes less beneficial and in fact can hurt your ability to raise money is if you are looking at launching a $100 million, $300 million, $500 million fund, and your investors are pension plans, endowments, and institutional investors. The theory or the theoretical risk of piercing the corporate veil that Simon's speaking about, even though we are not necessarily concerned about how we are running our series, the underlying investors' sophistication level will cause them to run to the hills, and they will tell you to set up a separate structure, and they'll invest in that.
Awesome, thank you. So second is other con we were thinking about the ambiguity, right? So I think how about the IRS, right? Is this okay with them, this concept of fund series? Are they really catching up with this idea? Or still, it is foreign to a lot of regulators or other service providers? Can Greg or Simon some light?
Greg, do you want to take a first shot?
Sure. Yeah. In terms of ambiguity, so the Series LLC is been around for 20 plus years, but it's evolved, right? And people are finally using it, I think, in the way that really benefits them. The use case has kind of grown over the years, and as obviously you have smaller managers starting in the past kind of 3 to 5 years, I would argue. You have a lot more people trying to start smaller funds, which makes sense if there's a firm like FundViews behind it that can aggregate those and share the economies of scale across multiple different series. Now there's, again, we've kind of touched on this a few times. I think it's not necessarily clear cut what the risks are of piercing that corporate veil, for one, and other operational risks of having, for instance, one manager across the board. There's reputational risk. I mean, that's, I think, a bigger risk than the piercing of corporate veil is that you have one series on the FundViews platform that becomes an issue in the news or otherwise, and it sours the FundViews name. The same way that it would sour an audit and tax firm or an administration firm that has a blemish on the record. That's why we take it so seriously. When we're structuring this stuff, because our business relies on the fact that we take it seriously. If there is an issue with how we structure or how we're operating our funds, then our business is most likely dead in the water. And we spend a lot of time building our business, so we don't want to run into that issue. We do believe reputation is everything in this industry, and we want to really protect that.
No, I thought that was a very good answer. In terms of, certainly every year that goes by, as Greg mentioned, it's been over 26 years now that the Series LLC has been out there, and I think consistently the courts have upheld the statutory contours of the Series LLC, and we've seen no indication that the IRS is not recognizing a Series LLC. So I think hundreds of different funds are probably thousands at this point are utilizing it. So we feel comfortable that it's a structure that has durability and works for some managers, certainly not for all, but it's another tool. It's another tool in a manager's toolkit to potentially launch their funds or their SPVs.
Awesome. No, I think we covered a lot of ground. I hope participants really enjoyed our discussion. One last comment from everyone, right, before we conclude this session. And, what is the main best practice or main point you would like to tell the fund manager who is thinking or on the edge to launch Series LLC? Start with Steve, right? What do you think he should be most worried about, or should be most what's the main point he should be?
Well, make sure that it's going to fit whatever strategy he is doing, right? You don't want to start a Series LLC if you're just going to run a long short fund, right? Make sure that if you choose to go down this road, that it in some way, shape, or form matches up with what your strategy is and what your future strategy is. Because if you don't have those two aligned, this structure doesn't do anything for you.
Simon?
Yeah, I would agree with that. I think for the majority of managers, setting up their own series LLC is not necessarily the best approach and doesn't have really compelling advantages unless, you know, as Steve said, they're planning on launching, you know, multiple SPVs or funds or where, you know, given the volume of their launches, there may be some incremental benefits. What I would say is there is some compelling benefits to utilizing someone else's series LLC structure, especially for emerging managers, where there's you know, ongoing support from a team that you know, has launched many funds. So I guess I would leave it at that.
That's a very good point. We didn't touch that point, but I think in our next conversation, we should do that. Greg, please, from you.
Yeah, I think on my side, you know, to differentiate and add to, you know, the comments from Steve and Simon, I think one of the most important pieces is don't cut corners. You may be thinking that by, you know, doing something a little bit cheaper or skipping a filing or doing something at the entity as a whole level versus a sub-series level might save you, you know, $500 here or $300 there. At the end of the day, that's a small price to pay for a potential mishap, right? And that can really, really deter your business down the road. So I think, you know, managing it properly and not cutting corners is the number one key to running a successful series LLC or a platform.
Awesome, thank you. I mean, I would want to thank you, Steve, Simon, Greg. Thank you for your time and helping not the participants, but also for the people who want to learn about this topic. These webinars and the PowerPoints would be available on our YouTube channel, and we can definitely share with you if you have not, if you're not able to attend this webinar. Thank you, everyone.
Thanks very much, Mohammed. Really
Thank
enjoyed it.
Thank you, everyone.